alaikum.
Assalamu alaikum.
How are you, Eliza?
Very good, ma'am. How are you?
I'm too good. If you have any question, you are free to ask through the chat box, or even you can unmute the mic as well. We are doing the LO1 at the moment, which says that understand the financial and management accounting systems. We already did the AC 1.1 in the last class, and half of the part of 1.2 as well, that is the financial techniques. In today's class, we will be covering the management techniques. This is the command prep through which we are going to complete our assignments and tasks. So the word analyze actually means we have to define a word or whatever the phrase is, term, and then with an example, we're going to explain it in a para. And afterwards, we're going to tell the issues, problems, and the importance to it as well. And in the end, we're going to relate it with the different theories. Theories in a way, articles, research paper, thesis, we're going to pick few lines and we are going to sum up with an answer. So these are the things which are included in the management accounting. Cost accounting systems, inventory management system, cash flow forecasting, capital investment appraisal, budgeting and budgetary control, marginal and absorption costing, and lastly, break-even analysis. The first system of the management technique is cost accounting system. Cost accounting system involves tracking and recording all the costs associated with the production, operations, and other activities within the organization. That is, whatever the daily, day-to-day cost has been encountered in your business on the daily purposes, we are going to add in the cost accounting system. This helps in determining the cost of the goods or services and provides valuable information for pricing decisions, performance, evaluation, and cost control. Obviously, when we determine the cost of products, we are able to see what kind of prices we are going to allot to the products. And to that, we are going to see what how the product is going to perform in the market. Different methods like job costing. Now, there are a few methods through which we basically do the cost accounting system. There is job costing, process costing, activity-based costing. These all can be employed based on the nature of the business. That is, we apply this on different employees, and then we are able to see how many or how much quantity of cost is incurred in the daily basis, on the daily basis, sorry. Then the importance of cost accounting system is that it tracks and allocates the cost to the product, services, or the projects. So all the cost which is inculcated to the products, to the projects, whatever we are providing or doing in the organization is going to be under the cost accounting. This aids in pricing decisions, cost control, and profitability analysis. Now, this is the key features of the cost accounting. For example, an electronics manufacturer uses cost accounting to determine the total cost of producing a specific model of a smartphone, considering direct materials, labor, and overhead cost. Now, these all things are involved while we are making any of the product. We have to see what sort and how much cost is going to be incurred to make a product or to launch a product. The second step, or you can say the second method of the management system, management accounting procedure technique is inventory management. Inventory management helps in monitoring the levels of raw materials, work in progress, and finished goods. That is, whatever the production is going on in the department related to the products which we are going to produce in the future, we are going to track in the inventory plus the goods which have been produced fully, the finished goods. Efficient inventory management ensures that the right amount of NP is available to meet the customer demand while minimizing the cost and the risk of stock-ups. This is how the efficient multinationals and even the SMEs work. They do have bulk stock, but they know that how to sell this out to the local consumers or to the loyal consumers. For example, these techniques are basically used to calculate the inventory management system. These are the EOQ, that is the economic order quantity, just in time, that is all whatever the order has been placed at the moment, we are going to calculate right now. and ABC analysis aid in optimizing inventory levels. Now, these are the names of few of the techniques which we use in inventory management system to calculate. Then it helps to optimize the inventory levels, reducing the carrying cost, and ensure efficient production and distribution. For example, what happens is when we produce a lot of product in bulk amount, what happens is we have to sell it in a less price, or we have to give those products to our retailers or vendors so that they can sell it out to the local consumers. For example, a retail store employs an inventory management system to track the movement of the products, ensuring that popular items are well stocked while minimizing the risk of overstocking slow-moving products. Any questions? Cash flow forecasting. Now, this is about, it involves estimating the future cash inflows and outflows of an organization. That is, whatever the cash is coming in the organization and what is going outside. This technique helps in ensuring sufficient liquidity for the operations and planning for the capital expenditure. That is, whatever we are going to do, the big expenditures in the future, this specific cash flow forecasting is going to calculate it. By monitoring cash flow patterns, business can anticipate periods of cash surplus or shortfall and take appropriate actions. For example, we are running out of the budget or a cash. What we're going to do, we are going to ask the stakeholders of the organization. Now, this is in assisting the predicting future cash inflows and outflows, enabling the business to manage liquidity. That is how much cash we have in the business. Plan investments. Obviously, when we have large amount of investment, as in cash, only then we are able to do the investments and ensure timely payments to the suppliers, to the producers, to the creditors. For example, a small restaurant uses cash flow forecasting to anticipate the periods of high demand and low demand. That is when the period of high demand occurs for example, in winters, the demand for fish ultimately rises. So this is how the cash flow forecasting works. The small vendor or the small restaurant owner CEO, he is going to make a budget in such a way that in the winters, he is going to specifically save the cash, save the amount, so that he can bring the fish and produce so many dishes to the normal or to the local people. This helps them allocate the resources appropriately and manage cash reserves. Then we have capital investment appraisal. So capital investment appraisal techniques assist in evaluating the potential returns and risk associated with the investment projects. Obviously, when we invest amount in any of the project, in a business, in an organization, we do have associated risk with it. We know we are going to win as well, but we know that it's risky as well. Investment is only done when we take a risk. Techniques like net present value, internal rate of return, and payback period help in assessing whether a proposed investment aligns with the organization's strategic goals and generates value return. Now, these are a few, you can say, management technique, specifically in accounts, through which we calculate the capital investment appraisal. And I think in task 4 or 5, we are going to work on these investments, on these techniques. So when I'm going to be discussing task 4, 5, I will be giving a detailed lecture on these. Okay. Now, these techniques such as net present value and internal rate of return help assess the viability of long-term investment projects. When we want to know the growth, the budget of the long-term projects up to 5 years, 10 years, 20 years, we only use these. For example, a manufacturing company evaluates the potential purchase of new machinery. By using NPV and IRR, that is internal rate of return, they determine whether the investment will generate sufficient returns to justify the cost. Obviously, we did an investment in a project. So we want a return which must be double or triple. Only then this project is going to be liable or successful in the future. Then we have budgeting and budgetary control. Any questions so far? Okay. Thank you, Mark. Budgeting and budgetary control. Budgeting involves creating a financial plan that outlines expected revenues and expenses for a specific period. So By the name, we can easily guess that what budgeting and budgetary is. Budgeting is in which we do all the calculation to remain in the budget. Budgeting control involves monitoring actual performance against the budget and taking the corrective actions if necessary. That is what is happening at the moment and what we're going to be expecting in the future. Budgeting helps in resource allocation. Resource allocation is how we manage all the resources. Because resources are scarce, they are very less. So we have to use each and everything very efficiently. Setting performance targets and fostering accountability across the departments. That is, fraud, fudge data is very common in various businesses, specifically in this department, the budgeting one. So it's the responsibility of the accountant that they should be accountable to all the departments, whether they are doing the work efficiently or not. Is there any sort of fraud going on? Then, important starts. It involves setting financial targets and comparing the actual performance against these targets. That is, we have set some rules and regulations regarding some projects. Now, what actually we are achieving, we are going to compare it with the budgetary things. It ensures effective resource allocation and cost management. For example, a software development firm creates an annual budget that allocates funds for research and development, marketing, and operational expenses. So it's very common. Even in the houses, what happens is the mother specifically, they always do budgeting for the kitchen, for the groceries. Why? Because they have to keep everything in a budget. Throughout the year, they monitor actual spending against the budget to make necessary adjustments. Then we have marginal and absorption costing. Marginal costing, also known as variable costing, focuses on segregating the fixed and variable cost. Fixed cost is the one which doesn't change at all, no matter what. And variable is, it changes by the level of time period. After 1 month, even after a day, after a week, it changes. To determine the contribution margin of the products or services, it aids in making short-term pricing and production decisions. Whatever short decision we have to take regarding the price, we are going to use marginal costing. But for the absorption costing, it is for the longer period of time. It allocates both fixed and variable cost to products, providing a comprehensive view of the total cost and profitability. Now, total cost includes fixed and variable as well, but what is the level of profitability as well? Whether we are going to reach a boom in the business or a saturation. Now, marginally, it helps in understanding the variable costs associated with the production, while absorption is related to both variable and fixed. So this is the biggest difference between both. That is why marginal caters with the short-term decisions on pricing making. These methods aid in pricing and decision-making. Specifically, for example, an automobile manufacturer uses marginal costing to determine the incremental cost, that is the increase in the cost of producing an additional car. That is, what if I produce, my budget is producing of a 50 car, but I want to produce 52 cars or 60 cars. So obviously my budget, my prices, they are going to be increased. This information guides pricing strategies for the promotional sales. Okay, then we have break-even analysis. Business students, they must be very sure that what break-even is when we reach the profitability level. It determines the point at which total revenue is equal to the total cost, equal resulting in a zero profit. That is, our revenues, our sales revenue, they are all equal to the total cost, that is fixed plus variable. This technique is valuable for understanding the level of sales required to cover all the costs and assessing the impact of changes in sales volume or pricing on the profitability. Again, this is the importance. Let's go on to the example. A startup technology company calculates its break-even point to determine the number of units they must sell to cover the fixed and variable cost. This information informs their sales target. So whenever we're going to talk about the sales revenue, this means we are talking about the total cost. That is the fixed plus variable. Variable changes, but fixed doesn't. I think it's the end. Management techniques play a vital or important role in recording and analyzing financial information. As the financial techniques, management also has a very high level in the accounts. Each technique serves a specific purpose, such as cost allocation, profitability analysis, investment evaluation, decision making, contributing to effective financial management within the organization. Now, without these techniques, we cannot even pursue our financial techniques as well. So these both things have to move side by side. We are done with 1.1, 1.2, and now we are moving towards the merit, that is 1M1. Evaluate the benefits of financial and management accounting systems for a specific business organization. Now you guys are level 4, right? For you guys, it is highly advised that you have to use an SME for the examples. Why? Because it is more easy to handle and tackle the data. So you have to use SME. Going towards the command verb, what evaluate means, it means we are going to focus on strengths and weaknesses. I believe till now you guys must have learned these things, because to be very honest, without even looking at the slides, I know that what this verb means. So it caters with the strengths and weaknesses, similarities and differences, and you have to tell the perspectives of different authors. Okay. Now I gave the example, because I did as an assignment for you guys. I give an example of a retail clothing organization, that is Qmade. Now, the steps which I'm going to discuss, these are going to be deviated into two parts: financial accounting system and management. And then we will be discussing it overall as well. So let's start with the financial one. The first thing is accurate financial reporting. A financial accounting system ensures that Qmade, XYZ brand, any SME, financial statements, including the income statement, balance sheet, cash flow statement, accurately reflect the company's financial performance and position. Now, these all statements which I named, these are all related to the basic accounts, basic finance. This is crucial for the external stakeholders like investors, creditors, and regulatory authorities. Why? Because they are the one which are actually investing in the business. They are giving huge amount of money so that this organization, specifically for the clothes, they can prosper further. The second benefit is compliance with the regulations. Now, the financial accounting system helps Qmade adhere to accounting standards and regulatory requirements. It ensures that the company's financial reporting is in line with the generally accepted accounting principles. Now, this is the overall gap. It's a term as in generally accepted accounting principles through which all the world international standards have to meet them. For example, the IFRS as well, International Financial Reporting Standards. These basically enhance the transparency and credibility all over the organization, even if it is on a national level, even if it is on a domestic level or a multinational as well. Then we have other benefits as well, inlined investor confidence. Transparent financial statements generated by the system enhance investor confidence. When we are clearly talking to the investors, as in we are registered in the stock exchange market, stock exchange is where the shares are traded or the stocks are traded. So they need to know the financial position of our business for our organization. Only then they are going to be motivated to invest in RB XYZ organization. So the investors can make informed decisions about investing in Qmade based on the accurate and reliable financial information. Then we have tax planning and compliance. This financial accounting system helps Qmade accurately calculate its tax liabilities. What are tax liabilities? The one which we have to pay to the government. It tracks income, expenses, and deductions, facilitating tax planning and ensuring compliance with the tax regulations. In every country, in every business, we are liable to pay taxes. However, the big MNCs, what they do is, like multinationals, they buy different paintings from the auctions, from different museums, and then they put those in the orphanages, NGOs. What happens is, in the eye of a government, they are not liable to pay taxes. And this is how big organizations are able to manage more revenue for themselves. Then cost control. This system allows Kumade to track and analyze expenses, enabling effective cost management strategies. We learned this today in the management techniques. This is important for optimizing profitability and ensuring the business operates efficiently. Obviously, when you are controlling all kind of costs in the business, you're overheading everything. So it's very obvious that we are going to be working efficiently and we are going to achieve the profits in the longer terms as well. Okay. We are done with the financial techniques. Now we have to move towards the management one, and here it is. The first benefit is performance analysis. A management accounting system provides Kumadi managers with insights into the company's performance. They can access factors such as sales, trends, product profitability, and cost variation. Now, the people which are actually working in the Department of Performance Analysis, employees, they specifically work on what the sales trends, what is going on in the competitors and in the market, in the industry, then product profitability, whether this product is going to be profitable or not, and cost variations, the different cost. We have to give sell products to the various kind of people, consumers, the middle class, upper middle class, elite, lower one. So it's the responsibility of the business to cater each and every type of group. Budgeting and planning. This system assists in creating budgets and forecasts. They can set financial targets, allocate resources, and measure the actual performance against planned goals. We have planned this much thing for the Day to be successful in up to coming 5 years. But what if we are not able to achieve that in 5 years? We're able to do it in just two years. Okay, we're left with 10 minutes. Decision-making support. Management accounting provides relevant financial data for informed decision-making. For instance, Kumadi management can assess the viability of introducing a new clothing line based on the cost projections and potential revenue. Obviously, just leave this brand or retail clothing. In general, how do we make a decision-making support? When we are working in a team, as a team, we are able to get to know what is in everybody's mind, and then we are actually working on all the costs which are going to be inculcating in this product, in this launch of a clothing line. So this is how decision-making support specifically works in management accounting system. Then we have the rest of the benefits as well, which includes variance analysis, inventory management, and customer product analysis. Variance states the system enables Kumadi to compare actual results with the budgeted figures. The one which we have assumed, we are going to see whether we were able to achieve it or not. Identifying discrepancies and reasons for deviation, that why there were problems, why there were discrepancies, issues in achieving the specific target or the budgeted figure. This helps management take corrective actions promptly. Obviously, when we're able to figure out what the problem was, we are going to take the action accurately, and we are going to be very careful in the future as well. Inventory management. Management accounting helps optimize inventory levels, stock levels by analyzing the turnover rates and identifying slow-moving items. That is, how many people are leaving your organization. And slow-moving items, the one which are not getting scaled up quickly. This ensures Kumada doesn't tie up excess capital in unsold stock. So they are producing efficiently. Lastly, we have customer and product analysis. This system allows Kumada to analyze customer preferences and buying patterns. This information can guide marketing efforts and inventory decisions. Are the benefits clear, guys? What we did is I exactly make sure that we should, I should teach you guys how you're going to do in the assignments, in the tasks, the merit part. That is why I explained you through the example of Kumadi. But if we talk about the overall benefits, I even discussed those in the slides. Now, these include improved decision-making, Accurate financial and performance data empower its management to make well-informed decisions driving growth and profitability. Obviously, when we are very enthusiastic in making a decision, we are going to prosper further as well. And when there is a prosperity in any business, this means we're going to encounter the profitability as well. Then we have resource allocation. Both systems, that is the financial and management, they enable efficient allocation of resources, ensuring optimal utilization of funds, labor, and inventory. This is what allocation of resources. That is, how do you use your resource, the land, labor, capital in the business? It should be using, like you as a entrepreneur, as a CEO, we should use it for a longer time. Transparency and accountability. The system enhance transparency in financial reporting, building that is the income, balance, and cash flow forecasting, building trust with the stakeholders, and ensuring accountability within the organization. This is how we depict transparency and accountability. Then we have risk management. By analyzing the financial data, it can identify potential risk and take appropriate measures to mitigate them. That is, we're going to deviate them. We're not going to, we're going to, what actually the word is, we will be saved from this risk and frauds if we do take the risk management accurately. Then lastly, we have strategic planning. The system facilitates long-term planning by providing insights into financial trends, market dynamics, and competitive positioning. Now, financial trend is what is actually happening in all the past data, that is the income balance and cash flow, and what's going to be happening in the future. We're going to be making a predictive statements. Market dynamics, what is happening in the industry, in the market, nationally and internationally, and competitive positioning, what your competitors are doing. Then this is the conclusion, the financial and management accounting system. This should be over here, I think. Yes. Because afterwards, we're going to discuss financial management of accounting system offer cumulative robust framework for financial reporting, decision making, and strategic management, ultimately contributing to the company's success and sustainability. That is how longer it goes on. This is how you end up an answer. And this is what I'm expecting from you guys as well. Because, when in the end, the teacher has to check your assignments, it just babbles up my mind that the way I taught the children, the students, the candidates, they did not perform well in the assignments. So it's a request. Kindly be on time and be attentive in the class. Because in the end, your grade is going to matter. Okay, then lastly, we are going to be covering the distinction part, and it will be end of the LO1. It states, evaluate how a specific business, in your case, it's going to be an SME, integrates financial and management accounting systems into the organizational process. That is, XYZ business, how they're using the financial management accounting systems in their daily organizational process. That is, the day-to-day operational management, the expenditure management, everything is going to be included in this organizational process. A manufacturing company, I give the example of Tech Innovations, to evaluate how they integrate financial and management accounting systems into their organizational processes. The first one is, obviously, it's an IT company, so I'll be starting with a software platform. Tech Innovations uses an integrated enterprise resource planning ERP system that combines financial and management accounting functionalities. That is, whatever the function is going to happen in the finance and management, this system specific is going to be accountable for it. This central system allows seamless sharing of data between different departments. That is, it is going to be installed in everybody's, this system is going to be installed in one computer, the one which is going to handle the ERP in total. And whatever the data or search or whatever you're doing in your PCs and your laptop, that data is going to be driven in where? It's going to be in ERP. Data synchronization. The ERP system ensures that financial transactions reported in the financial accounting module automatically update relevant data in the management accounting module. That is, we have two different departments, for example, the finance and the management. So it's obvious whatever is happening in the finance, we have to record in the management as well. Variability. For instance, when sales are recorded in the financial accounting, the sales figure are immediately available for the analysis in the management accounting. So the calculation work is going to be in the finance, but the interpretation in detail is going to happen in the management accounting. Then we have shared chart of accounts. Sorry. Tech Innovations maintains a consistent chart of accounts that is fused in both financial and management accounts. This alignment ensures that the same account codes and categories are used across the organization for the consistent reporting and analysis. For example, isn't it going to be very deviating that if you, like every student of my class is going to do a different assignment, as in a type of format, they are not following the rules accordingly or whatever they were stated to do. That first you have to define something and then you have to explain. So it's necessary that everything should be very equal in the organization. Only then we are able to make a perfect analysis. Real-time reporting. The integrated system allows for the real-time reporting of the financial and operational data, that is the daily basis data. Managers can access up-to-date financial statements, the balance, the income, the cash flow statements, and performance reports. That is, first we are going to make these and then we are going to report on them, enabling them to make timely decision based on the accurate information. It is very necessary that we provide the accurate information because the next step is the decision making. So it is going to be impacted by it. And the overall production is also going to be impacted by it. Then we have cost allocation and analysis. The ERP system facilitates is everything clear? I didn't ask it. Okay. Cost allocation and analysis. The ERP system facilitates allocating costs to specific products or projects. This helps in determining accurate product costs, analyzing profitability, and making informed pricing decisions. Again, this is the same thing which we discussed in the management accounting system. When we're able to allocate the cost to the specific products and services, then we're able to make the further decisions in the businesses as well. Then we have budgeting and forecasting. The integrated system enables tech innovations to create budget based on historical financial data and operational trends. Actual financial data from the financial model can be compared to budgeted figures. So whatever you have assumed, it should be compared to the actual one. Then we have variance analysis. The ERP system automatically generates variance reports by comparing actual financial results to the budgeted amounts. This alerts managers to deviations from the planned performance and helps them identify the reasons behind the variances, that is the differences. Whatever the differences were in the report in the ERP system, it's going to be detected through variance analysis. Then we have inventory management. The integration allows tech innovations to track inventory, that is for stock, levels in real time. This data is shared between financial and management accounting, helping the company optimize inventory levels and reduce carrying cost. Then we have decision support dashboards and cross-functional collaboration. So the decision one is tech innovation uses customized dashboards that present key financial and operational metrics. So these are the few metrics. One of those are financial and the operational one. These are specifically used in the tech industries. These dashboards provide a consolidated view of financial and management accounting data, aiding in a quick decision making. Then we have cross-functional collaboration. This integration of the financial and management accounting encourages collaboration between finance and other departments. This collaboration enhances data accuracy, reduces duplication of effort, and ensures consistent reporting. That is, we are going to ask cross-questioning department whether this department has done the work or not, and the same thing is going to be asked from the other department. In this way, overload and overburden is going to be reduced. Then benefits of integration. This includes efficiency, accuracy, timely decision making, holistic view, cost control, strategic planning. So efficiency is integration, which reduces the manual data entry, that is, we do it by our hands, minimizes errors, and eliminates the need for the data duplication, leading to efficient processes. Accuracy. Data consistency and accuracy are maintained throughout the organization, ensuring reliable financial reporting and analysis. When we are accurate, we are performing non-fudge data in the organization. We are more confident about our reporting and analysis of the finance. Timely decision making. Real-time access to the financial and operational data enables quick decision-making based on the current information. So what is happening? At the moment of the organization, we are going to take the decisions accordingly. So that is why timely decision-making always is a win situation. Holistic view. Managers have a comprehensive view of financial performance alongside operational insights, facilitating well-rounded decision-making that is an overall decision. Then we have cost control. Integration enables better control with the cost by tracking and analyzing expenses across the organization. Whatever the cost is going on in each and every department to make a product, to produce a product, this specifically cost control helps in it through integration, through entering in it. Strategic planning. Integrated data supports long-term strategic planning by providing insights into financial and operational trends. Lastly, it's the sum up of the lecture of this specific distinction AC. That is assessment criteria. Tech innovation demonstrates how the integration of financial and management accounting system enhances operational efficiency. That is, when financial and management integrates, they meet with each other in the department. What happens is it increases the operational efficiency, that is the day-to-day activity efficiency. Accuracy, your data is accurate, so there is a less chance of fraud. Decision-making across the organization. Now, this integration ensures that financial data is not isolated, but it is closely tied to the operational information, fostering a holistic approach to managing the company's resources and performance. Any question from today's lecture, guys?
Yes, ma'am.
Is the lecture clear?
Ma'am, no questions, ma'am. Yes, everything is clear, alhamdulillah.
Thank you. You guys may leave the class now. Thank you so much.